take a look at some of the markets data for Easter holiday. I think the Hang Seng market is still closed. So the Shanghai Composite Index down by 37 basis points. The Kospi in Korea up by 87 basis points. The Nikkei 225 in Japan pointing upwards 42 basis points. Let's look at the crypto prices. Bitcoin back above $28,000, up by 1.54%. Ethereum now has touched it's crossed 1,800. Ethereum had been languishing about $1,500, psychological levels, if you will, now climbing above 1,800. The global exchange rate, seeing the U.S. dollar there weakening a bit against the euro, the pound, the yen. They've got their new governor coming in over in Japan. What will that mean for monetary policy? Also, the Canadian dollar appreciating against the dollar as well. Oil prices earlier in trading on this Easter Monday. Brent crude, $85.33 a barrel, up by 27 basis points. West Texas Intermediate, $80.99, up by a quarter percentage point. Let's bring in FXTM Senior Research Analyst Lukman Otunuga. Lukman, good morning to you. Thank you so much for joining us. I want to start with markets, of course. What's your preview for the Asian indexes as we begin the week?
Digesting the U.S. jobs report we had on the holiday on Friday. I don't think we'll see much in Asian markets this week. However, though, keep an eye for next week. There's lingering fears that Chinese economy could be growing slower than expected based on the fact that we've got report from biggest retailers, JD and Alibaba. Consumers are quite cautious. China's exports have also fallen, and at the same time, we've got the lingering impacts of the retail sector. So, yeah, Asian markets are mixed right now, but I think next week it could be a hot topic for us to reach out for.
Are geopolitical concerns, I guess, between China and the West still going to weigh on markets this week? You look at the Taiwanese tensions, for instance, that visit to the United States. Is that a catalyst?
Certainly, when we look at things, China markets are a bit low today due to the heightened geopolitical tensions. On that side, there's reports that China's actually began a 3-day military exercise after the Taiwanese president has actually returned from a brief visit to US. Ultimately, this is going to have political, social, and economical consequences on, the wider Asian space. But I think this week it may be shifted to the background as markets focus more on inflation as the banking turmoil eases further.
Well, what about the European markets? What can we look forward to this week?
Yeah, European markets are closed right now, but we've got some key economic data to look out for. Keep a very close eye on the Eurozone February retail sales midweek. We've got industrial production and German data. Ultimately, with Europe right now, it remains heavily influenced by ECB rate hike expectations. And if these economic reports continue to, build on the case that the ECB can continue to raise interest rates, this may weigh in European equity markets, on top of the other geopolitical and external factors that we have on the radar this week.
In fact, speaking of those geopolitical factors, Emmanuel Macron, Ursula von der Leyen, last week, both in China, will the European markets be looking at that, for instance, and what's to come out of that visit?
Absolutely. This has been a key visit. A lot of, people are looking at on the political front as well. It's all about those peace talks in Ukraine and, whether they can actually get, the Russian President Putin involved as well. Ultimately, if the talks are positive and it does show that it could result in easing tensions, this could feed back to European markets. But, this is more of a political thing and the impacts are more long-term. We may not see an immediate reaction this week.
What is the state of mind of the Bank of England right now? So as far as Andrew Bailey is concerned, what's he looking at?
Yeah, so in the UK, it's almost the same story. According to markets, the Bank of England is expected to raise interest rates by 25 basis points. There's a 61% chance that next month they'll raise rates. When we look at it, inflation expectedly rose in the UK, despite inflation easing in different sections of the world. At the same time, economic data has been mixed. The Bank of England, like most other banks, are in a tough battle choosing between price stability and financial stability. But the good news is, with the banking fears somewhat easing, the Bank of England could focus more on inflation and could move ahead to continue tackling inflation by raising rates a couple of times before the end of 2023.
I think he said, Andrew Bailey did say that he sees inflation easing. I think it was, 13% was what he said, or maybe even lower than that. Do you see those inflation headwinds I guess, coming off the boil as the year progresses, or do you think inflation is still going to be heightened?
Certainly, and this will be heavily influenced by energy prices. One of the major drivers behind inflation rising in the UK and most Western across the world is, rising commodity prices. Interestingly enough, until the OPEC shocker that we witnessed last week, commodity prices were moving lower, and that fostered the argument. But now, with what OPEC has done and the prospects of, higher oil prices leading to higher energy prices, the Bank of England, like many other banks across the world, could be in a pickle.
That's going to be very interesting going forward. All right, so I guess the same issue for the ECB and Christine Lagarde. They have said they would stay the course with respect to rate hikes and so on. How do you see them navigating their headwinds over for the wider EU?
Yeah, certainly. Like the Bank of England, the European Central Bank is also expected to raise rates by a modest 25 basis points next month, unlike the aggressive 50 basis points we've been seeing. Interestingly, though, in Europe, if you look closer, consumer expectations for Eurozone inflation fell to a 2-month low last week, and inflation pressures have been falling considerably. If you look at the recent inflation figures, it actually dropped to 8 to 6.9% in February compared to the high 8.5% seen at the start of the year. So the European Central Bank is in an easier place compared to other central banks, and I believe further signs of easing inflationary pressures should force ECB hawks to take a pause and, invite ECB doves, and ultimately the ECB could be seen pausing rates by the end of 2023.
That would be very interesting, considering that they said they were going to stay the course with hiking rates. All right, to the U.S. market. U.S. markets preview. Will we see, I guess, a reaction to the job numbers that we got on Friday, Easter Friday?
Yeah, certainly. We can call this a Goldilocks U.S. jobs report. It was within expectations. Payrolls increased by 236K in March. Unemployment fell to a record low of 3.5%. It's one of those jobs report that continue to show resilience in the U.S. labor force and also showed that the U.S. economy may not be heading for a recession. Ultimately, this boosted expectations over the Fed raising interest rates by 25 basis points next month. However, though, markets still believe that the Fed could still be in line to cutting rates as soon as September.
So is the Fed, walking a tightrope, here as far as Powell is concerned? I mean, how are they going to navigate this?
It is a certainly tightrope because even though we are seeing the concerns over the banking fears easing, I think that those lingering fears are still there. And we have to keep in mind a few weeks ago, before the economic data was improving, there were growing concerns that the Fed's aggressive approach may lead the U.S. economy into a recession. So with the things developing right now, the Fed is still taking a tightrope. However, they may adopt a more cautious approach and, be careful with rates. I think moving forward, after raising rates by 25 basis points next month, they may decide to pause before slowly loosening monetary policy in an effort to stimulate economic growth in the United States.
Lukman, if I was to ask you who's under the most pressure between Jerome Powell, Andrew Bailey, Christine Lagarde, is it evenly shared across, or who's under the most pressure between the three of them?
I think looking at everything, my thoughts would be the Federal Reserve, because the Federal Reserve is the leader of the pack. What the Federal Reserve does, everyone else follows. It's the largest economy in the world. They're the ones still, sorting out with inflation. The banking crisis happened in the US. We saw the collapse of 3 major US banks. So I would think the Fed is under the major pressure, and this would even put them under extreme pressure to choose their words very carefully moving forward to not create another explosive market volatility.
Okay, let's hop to currencies. How do you see, I guess, King Dollar, as you like to call it, against, the yen, the euro, the pound, and so on? How do you see the currencies playing out?
At the start of the year, I did say that I believed that dollar weakness was going to be a major theme. I still think that's the case. Despite all of the volatility, uncertainty, and that, fundamentally, nothing much has changed. When the Fed starts to cut interest rates later this year, the widening interest rate differentials between the dollar and other major currencies should see more dollar weakness. Looking at other currencies, it's the same narrative. The yen, it's something I'll be looking at very closely. We are seeing that inflationary pressures are rising in Japan. So the Bank of Japan has less reason to adopt a ultra dovish stance, and the new governor coming in as well, that could add more spice to the mix. I won't be surprised if the combination of these two things results in a stronger yen. Looking at Europe, interestingly, voters, the euro has been one of the best performing G10 currencies in the first quarter of 2023 due to the fact that the ECB has been one of the most hawkish central banks. And I think moving forward, euro strength should be a major theme. So dollar weakness, yen strength, and euro strength. This are the things I'll be looking for over the next few weeks.
All right. Thank you for that breakdown. What about good old precious metals with gold hitting recent highs? How do you think things are going to play out this week for precious metals and gold?
Yeah, we briefly spoke about gold last Friday, and as you can see, the gap down. Ultimately, this jobs report has forced investors to evaluate what the Fed is going to do moving forward. Gold is a zero-yielding asset, and it remains attacked by a stronger dollar and Fed hike expectations. But this week will be very key to determine how gold performs for the rest of April and even Q2. You've got the U.S. inflation report and Fed meeting minutes. Of course, we know inflation has been easing in the United States, but it's all about the core inflation figures. If this prints higher than expected, this should reinforce the case of more rate hikes and ultimately pulling gold prices higher. Technically, I rarely talk about this, but it's all about that psychological 2000 level. It's really been a tough nut to crack. Probably a monthly close above this level could take gold prices to the all-time high seen in August 2020 at 2075. But persistent weakness below 2000, we can see 1950 and possibly 1900 in Q2.
Wow, amazing. And is that push-pull still there between the haven for investors for inflation? Is the dollar still a big competitor with gold as far as where investors rush to when inflation is rising?
Yeah, certainly. I mean, it's still a tough tug of war. But, as we're seeing right now, with inflationary pressures slowly rising in the United States and, expectations swinging back and forth, it looks like the dollar's lost its strength and, more of the strength is coming towards gold prices.
All right. Let's round up with oil prices. How do you see that playing out as we get into the week?
After the OPEC shocker last week, it's fair to say that oil bulls are back in town. I think the prospects of, tightening supply, due to the fact that OPEC Plus have decided to cut production by over 1 million barrels a day starting from May is really supporting the, supply dynamics, pushing oil prices higher. However, this is a big week for oil. We've got a couple of key reports. We've got reports from OPEC, the IEA, the EIA, which should probably, provide further insight into the supply picture. Ultimately, if all of these reports, point to lower supply, this could be good for oil prices and push oil prices, push the commodity higher. But, on the other side of the equation, we've got the demand side. The first thing we spoke about today was about China. If China disappoints, we've got China GDP on the 18th. If there's slowing economic growth from the largest energy consumer in the world, this could balance things up and cap upside gains in oil prices. But this week, I think it's fair to say to expect more volatility for commodities, currencies, and stock markets, despite the slow start on Monday.
Wow, so much to get into. Lukman Otunuga, Senior Research Analyst, FXTM. Thank you so much for giving us the breakdown. I really appreciate your time, Lukman. Thank you so much.